Hello, everyone. This is Jay Garcia. I will be your producer for today's event, which is titled Form 8621, Mark-to-Market and QEF Basics, that will be presented by Deborah Rudd. But before we begin, I wanted to go ahead and talk with you a little bit about your webcast platform. As you'll notice, over to your left, you'll see announcements, and you'll see a tab called Class Chat. Class Chat is just for you and the other people online to go ahead and discuss the topic at hand. This chat is not monitored, so please, if you have any technical difficulties, do not put it in that chat. No one will see it. If you are viewing today's presentation with a group, please click on the Group Form Only tab located above the presentation. And if you have any questions for Deborah during the presentation, please click on the Ask the Instructor tab and type in your question. Now, before Deborah begins, I'm going to introduce Phil Hodgen. Phil?
Thanks, Jay. Hi, I'm Phil Hodgen, and welcome again to the monthly International Tax Lunch we do. And this is recorded in front of a live studio audience in Conference Room B from our law firm offices in Pasadena, California. And a not-so-subtle sales pitch, if you want to come and sit around the conference room table with us as we do this, let us know, and we'll even buy you a sandwich. And for what it's worth, we have a bottle of champagne in the kitchen we've never cracked open that somebody gave us, and we'll crack that open for you as well, so we'll get you drunk. This is the second Friday of the month, noon Pacific time is when we do it, and today's topic is, as Jay said, Form 8621, Mark-to-Market and QEF Basics. And for those of you who know and love PFICs, you know that they are horrible, and that's an understatement. There are two different elections, and Deborah's going to talk about them today, the Mark-to-Market and the QEF elections, that make it slightly less horrible in certain circumstances. So our speaker today is Deborah Rudd, CPA, and take it away, Deborah.
Hey, everybody. All right, so let's get started. We are going to be talking today. First, we'll just cover a little bit of the background of what is a PFIC, so you have that basic information getting started. We'll take a quick look at an overview of how PFICs are taxed in the three different ways using the default method, the mark-to-market method, or the QEF election. And then lastly, we'll talk a little bit about if you happen to be operating under one of these elections, either the mark-to-market and the QEF, and for some reason something happens and you want to switch to a different election, we'll talk about how that would work. So let's get started with what is a PFIC. And the definition of a PFIC is that it's a foreign corporation that meets one of two tests. There's the income test, which says that at least 75% of its gross income is passive. Or there's the asset test, which says that at least 50% of its assets are passive or are held for the production of passive income. And just keep in mind, you only need to meet one of these tests for it to be a PFIC. So what does foreign corporation mean? Foreign means it was organized outside the U.S., and then corporation is its designation under U.S. tax law. So it could be something else, some other entity in the foreign country, but be classified as a corporation for U.S. tax purposes. And if that's the case, and if it meets one of the two PFIC tests, then it would be a PFIC. So what is a corporation under U.S. tax law? That includes per se corporations under Regulation Section 301.7701-2B. Or if it's not a per se corporation, all other entities can elect their classification or take a default status based on these rules here. If it has two or more members and at least one person or member has personal liability, then the default classification would be a partnership. And if none of the members have personal liability, then it's a corporation if there's more than one member, or a disregarded entity if there's only one member. So following those rules, you can tell if you have a corporation on your hands. Now let's take a look at what we mean by passive. The word passive in the context of income includes interest, dividends, royalties, rents, annuities, gains, etc. Basically, you take this as defined under Section 954C for the purposes of the income test. Now, for assets, basically passive includes cash and any other assets that produce or are held for the production of passive income. And the way you calculate this for the purposes of the asset test is by taking the average of the assets at the end of each 4 quarters in the year. And just one note about that for asset test as well, you're going to be using fair market value of the assets, so you would not necessarily be just looking purely at what's on the balance sheet for these purposes. Now, most of the time, under the way the PFIC definition works, foreign mutual funds are going to be classified as PFICs, and I've received this question a lot over the years. Why is it a PFIC? It's not a corporation. Well, under U.S. tax law, it actually usually is. So, a foreign mutual fund is organized outside the U.S., which makes it foreign. It's organized for investment purposes, which means it's a foreign business entity. And a foreign business entity where the investors do not have personal liability is going to end up being a corporation. So even though it's not classified as a corporation under the foreign law, foreign mutual funds usually end up being classified as corporations under U.S. tax law. And then because they receive 100% passive income and hold only passive assets, they're usually going to meet both PFIC tests, even though only one is needed. So you have an entity that's foreign, it's a corporation, and it meets one PFIC test, so it's a PFIC. The easy way to know you have a PFIC, kind of a little bit of a shortcut, if you have a mutual fund or some similar kind of fund held in a brokerage or investment account overseas, and if it has an International Securities Identification Number, or an ISIN, starting with a country code other than US, then most likely it's going to be a PFIC. Here are some common examples of PFICs: mutual funds, exchange-traded funds, bond funds, currency tracking funds, a lot of precious metals funds, investment trusts, things like unit trusts, hedge funds, private equity funds. Startups are often PFICs, though they're not always, and there are actually some specific criteria that you can meet to use an exception for a startup qualifying as a PFIC, but in general, something you would want to watch out for. If it has a ton of cash in it, it might easily become a PFIC. And there's other things as well. This is not an exhaustive list. So how are PFICs taxed? There are 3 ways that PFICs can be taxed. The first is the default method, which we're actually not going to cover here at all today. But the very short answer on this is that under the default rules, you'd be paying basically a mix of maximum and ordinary tax rates. The income gets allocated over your holding period, and then different tax rates are applied to it. So it ends up being a mix of different tax rates. The really awful part is where daily compounded interest is added on top of the tax rates that you use. So that's exceptionally bad. Sometimes if you've held a PFIC for a very long time, you can have a very bad tax result just because of the interest. And then any losses that you have from sales would be capital. So this is in general a pretty bad result. And I really glossed over most of the details there. So that would be something that really not covered here today, but the main thing you need to know is just it's not desirable. The second method is mark-to-market, and we are going to cover that today. Mark-to-market PFICs are taxed at ordinary rates. There's no extra interest charges or anything, and there are limitations on how you recognize the losses, and we'll take a look at how that all works. And then QEF election, also going to cover that today. In general, that basically is a pass-through of income either as ordinary or at long-term capital gain rates. There's no extra interest charges like with the default method, and losses do pass through, but there are limitations on how that works. Generally, the QEF method is considered to be the least bad tax result, but you would have to look at your specific situation and see if that's actually true. Let's get started with how the mark-to-market election works. So we're going to cover a few different topics for the mark-to-market election. Very first is how it works, then we'll talk about who's eligible to make this, what type of PFIC stock you actually have to be able to make this, timing concerns for the election. We'll cover some special transition rules for people making the election for the first time, and for inbound immigrants, and then I'll talk briefly about the OVDP and the streamlined procedure. So, in very basic terms, what happens under the mark-to-market election is you make a pretend sale at the end of every tax year. You pretend you sold the PFIC, and then you recognize gain or loss under that pretend sale. Now, there are severe limitations on the loss recognition, and the way you track what losses can be recognized is through a term called unreversed inclusions. Unreversed inclusions, basically, you can recognize the amount of losses only up to the amount of previously recognized gains, and then that amount is reduced by any losses that you do recognize. And we'll walk through a very detailed example to see exactly what that means in just a moment. And then, of course, your basis is going to adjust up for each gain recognized and down for each loss recognized. So how are the gains and losses under the mark-to-market election taxed? Gains are always going to be taxed at ordinary rates. So whether you have a pretend sale at the end of the year and you're calculating the mark-to-market gain, or you actually sell the PFIC at some point and you have a gain from the sale, in either case, the gain is going to be taxed at ordinary rates. Losses are recognized and taxed at ordinary rates, but only up to the amount of your unreversed inclusions. So let's say you had a mark-to-market loss at the end of the tax year when you do your pretend sale. Your loss would not be recognized in excess of the amount of your unreversed inclusions in any case. But let's say that you sold the PFIC and you had a loss from the sale. That loss would be an ordinary loss up to the amount of your unreversed inclusions, and then any amount beyond that would be a capital loss. So let's take a look at an example of an actual mark-to-market calculation. So to see how this works, we're going to have to follow this through a bunch of different tax years so we can see a couple different scenarios and really understand how the rules work. So let's say that you purchased a PFIC on July 1st, 2012 for $10,000. At the end of the year, it's worth $12,000. At the end of the next year, it's worth $11,000. At the end of 2014, it's worth $8,000, 2015, $9,000, and then it's sold on June 30th, 2016 for $15,000. So in this table on slide 18, it basically tells you all the tax results, but we're going to walk through those slide by slide. But basically you can see when the market value goes up, such as at the end of 2012, you recognize a gain, your basis increases, and then your unreversed inclusions go up by the amount of the gain. The following year, the market value decreases, you recognize a loss, basis goes down, and your unreversed inclusions also decrease. And then in the subsequent years, it gets a little more complicated, so we'll follow those on the slides dedicated to each of those years. So starting with 2012, your 2012 year-end fair market value is $12,000. That's a $2,000 increase from your $10,000 purchase price, so you recognize an ordinary gain of $2,000. Your adjusted basis increases by $2,000, and you put $2,000 in your unreversed inclusions bucket. We're going to use the bucket metaphor for this because basically any unreversed inclusions you have, you put into this tally, you keep track of what you have, but it can never reduce below 0. You can never have less than no unreversed inclusions. So here's what your 8621 would look like in that year, and that's only, I'm only showing the Part 5, and this is the actual Part 5 from 2010 before they changed the form around. But basically you have market value of the stock at the end of the year is 12,000, basis is 10,000, gain is 2,000, and it says basically stop here, and that's going to be included as ordinary income. In the following year, 2013, the fair market value goes down to 11,000, so it's a decrease of $1,000. You have $2,000 in the unreversed inclusion bucket, so the loss is allowed because it's not more than your unreversed inclusions. So you recognize the $1,000 loss. Your adjusted basis decreases $1,000 to 11,000. You reduce your unreversed inclusions by 1,000, and you have $1,000 left in unreversed inclusions. All right, so this is how the 8621 Part 4 would look for 2013. It's a little more complicated than the previous year. Fair market value 11,000, adjusted basis 12,000. That gives you a loss of 1,000. And then on line 11, you put in your unreversed inclusions, and because the loss is not more than unreversed inclusions, it tells you on line 12 that you get to include an ordinary loss on your tax return. 2014, you have a fair market value of $8,000 at the end of the year. That means you have a decrease of $3,000 in the fair market value. But you only have $1,000 in the unreversed inclusion bucket, so you're only allowed to recognize $1,000 of loss. That means your adjusted basis goes down to only $10,000, even though your fair market value is $8,000, and you reduce your unreversed inclusions by 1,000, which is now going to be 0. And here's how that would look. You can see on line 10C, you have the loss of 3,000. Line 11, you only have unreversed inclusions of 1,000, so it tells you on line 12, you can recognize a loss of only $1,000. 2015, it's now worth 9,000. Your fair market value has increased 1,000, but because your adjusted basis is 10,000, you're not going to recognize that gain. So you actually recognize no loss and no gain in that year. Your unreversed inclusion remains 0, and your adjusted basis stays at 10,000. So here's what the 8621 looks like. 9,000 fair market value, adjusted basis 10,000. That gives you a $1,000 loss, and unreversed inclusions are 0, so you recognize no loss. Unreversed inclusions for 2016. You sell the PFIC in 2016 for $15,000. Your adjusted basis is 10,000. Your gain is 5,000. So at this point, you would just recognize the ordinary gain of 5,000, and then your unreversed inclusions increases to 5,000, but you won't be able to use it because you don't have any of the stock left. So that's the end for that PFIC. And when you sell the PFIC, you're looking at lines 13A instead of starting on line 10A. So you put the fair market value on the date of the sale, 15, adjusted basis 10, and your gain on line 13C is 5,000. So that's a sort of simple example of how the mark-to-market election works in general. Now let's take a look at who is eligible to actually make this election. It's going to be U.S. individuals who own PFIC shares directly or in a pass-through entity. And the other scenario where a mark-to-market election can be made is when there is a CFC that owns PFIC shares. And when you have a CFC making the mark-to-market election, it's actually the controlling U.S. shareholders who elect on behalf of the CFC. And if this happens, the election only applies to, quote, U.S. shareholders, as defined under Section 951B. And a U.S. shareholder is basically any U.S. person who has 10% or more of the voting power of that company. So if you had other shareholders who didn't meet that stock requirement, the mark-to-market election would not apply to them. They would not be able to use that election. The type of stock that's eligible, there are some specific requirements for this as well. Basically, it must be what's called marketable stock, and of course, that's a term that's defined in the code and regulations. Marketable stock is something that is regularly traded on a national exchange registered with the SEC or on another exchange or market that meets specific IRS qualifications. Regularly traded for these purposes means traded on 15 calendar days in each quarter or more. And the IRS qualifications for the stock exchange is supposed to be regulated or supervised by a governmental authority. It has specific measures in place to prevent fraudulent activity, and those measures are actually enforced. The market is free, open, and fair, and the rules of exchange promote active trading of stocks. Now, these are some kind of subjective criteria. It might be difficult just looking at any given exchange to make the call whether it meets these qualifications. So it's really a lot of judgment involved here. But in general, if you meet these qualifications, or at least can argue reasonably with a straight face that you meet these qualifications, then it might be worth it to take advantage of the mark-to-market election. Let's talk about some timing concerns. In general, the mark-to-market election has to be made with a timely filed return. There is an exception for that, but it's only allowed when you have a private letter ruling from the IRS and you've met certain requirements to get that private letter ruling. Those are that you must have acted reasonably and in good faith, and the result cannot prejudice the interests of the government. Important to consider in looking at this is private letter ruling fees and professional fees. Those are things that will definitely affect someone's decision on whether it's worth it to do this. Let's take a quick look at what's meant by reasonably and in good faith. Basically, not knowing about PFICs will not satisfy this requirement. The things that will work are things like you understood the election requirements and somehow your exercise of due diligence led you astray. You relied on some bad advice from the IRS or from a tax professional, or something like a natural disaster prevented you from doing what you needed to when you needed to do it. And by does not prejudice the interests of the government, that basically means it can't result in a lower tax liability. But of course, tax is usually lower under the mark-to-market than the default rules. Ultimately, I have come across almost no situations in which someone actually does the late election. The reason for this is the IRS user fees for the private letter ruling. I think it's a couple $1,000s. The professional fees involved probably also not going to be extremely cheap. Requirements of acting reasonably and in good faith, and that the transaction does not prejudice the interests of the government. The reasonably and in good faith thing is, probably the primary reason you would not be able to do this, because most people are going to say, well, I didn't know it was a PFIC. If I knew, I would have done this. And that unfortunately doesn't qualify under the IRS guidelines. So most people are going to end up choosing to make a timely election or none at all. And if you have a PFIC and you haven't made the mark-to-market election, there's actually a way to do that in a timely manner following some transition rules. There's three scenarios in which you would have a, quote, timely election. You have a U.S. person who acquired a PFIC in, let's say, 2016, and they're filing a 2016 return right now, so they can go ahead and make the mark-to-market election, and the rules would work normally the way you would expect, the way we just described before. Another way is if the person has held the PFIC for a while and wants to now begin making the mark-to-market election, they would need to follow the coordination with the default rules under Section 1296J. And basically the way that works is there's a year-end sale under the default rules, basically a deemed sale or a pretend sale, and then mark-to-market rules kick in at the end of that first year. And then lastly, we'll take a look at the transition rule for inbound immigrants under Section 1296L. And again, basically here the mark-to-market rules work the way you would normally expect, and there's also a step-up in basis component. So first, basically we're not going to look again at the way the rules work under normal scenario when you're just making the election the first year you own the PFIC, but let's take a look at the transition rules and the inbound immigrant rule. So under the coordination with Section 1291 rule, if you want to transition from the default treatment to the mark-to-market election, basically the first year of the mark-to-market election is taxed under Section 1291. So the first year that you're making the mark-to-market election, you're actually still following the default rules. So any distributions that take place during that year, any dispositions that happen during that year, are all under the default rules. Plus, there's a deemed disposition on the last day of the tax year. So basically, you have a pretend sale, again taxed under the default rules. And then it's not until the second year of the mark-to-market election that you're actually operating under the mark-to-market rules the way you would expect. At the bottom it says this will be 2015, but that's a typo. That was supposed to say this will be 2017. And then transition rule for inbound immigrants. This is actually a little simpler than the coordination with Section 1291 rule. So let's say a person immigrates to the U.S. and they already own a PFIC. They can just simply make the mark-to-market election in the first year that they're a U.S. person. And they also get a step-up in basis on the first day of the taxable year for purposes of calculating mark-to-market gain. They get to use the greater of fair market value or adjusted basis on the first day of the tax year for the purposes of calculating their year-end mark-to-market gain. And then for all other purposes, there's no step-up in basis. And when you sell, the basis step-up amount ends up being capital gain. Okay, so let's talk very briefly about the mark-to-market election as it works in the OVDP and the streamline procedure. Under the OVDP, there's a specific set of rules for what's called an alternative mark-to-market reporting. And basically this allows you to take advantage of a set of rules really similar to the mark-to-market rules for the purposes of the OVDP program only. The streamline procedure actually has no provisions for a mark-to-market election, and all the normal rules apply with respect to having to make the election on a timely filed return. So you're actually not going to be able to use the mark-to-market election in the streamline procedure unless you had already timely filed your 8621s and you're using the streamline procedure for some other purpose. So under the OVDP, there is a modified mark-to-market reporting. If you make this election to use this treatment, it applies to all the PFICs you have. The fair market value on 31st of December of the year prior to OVDP is your adjusted basis. So you do have to know your value for one additional year in addition to the OVDP period. And your mark-to-market gain or loss calculations are done for the OVDP years. Now, the way it's taxed is going to be not exactly the way you normally would tax mark-to-market PFICs. This is kind of one of the things that's different about it. The first year of the OVDP period is taxed at 27% of your mark-to-market gains, and then all of the other years are taxed at 20%. So normally you'd be operating under ordinary tax rates, and these special tax rates apply to just the OVDP method for mark-to-market. And then after the OVD period is over, the first year following, all of your unreversed inclusions moving forward are reduced to 0. But you can continue using the mark-to-market election for that time period. Okay, so that covers some really basic stuff about mark-to-market elections. Let's move on to talk about some basics of the QEF election. We're going to talk about how it works, who's eligible, specific paperwork requirements, timing concerns, transitioning to the QEF election using what's called a purging election, how and why you'd want to do that. And then again, we'll talk a little bit about OVDP and streamlined procedure rules. So the QEF election, how it works. In general, the basics here are that each shareholder computes a pro rata share of ordinary earnings and net capital gains. Ordinary earnings are going to be taxed at ordinary tax rates, and what they mean by ordinary earnings is the excess of earnings and profits over net capital gains. And there's some special rules for determining E&P in this context, but we won't really go into that level of detail. And then net capital gains are going to be taxed at long-term capital gains tax rates. And net capital gains just means the excess of gains over losses. And there's also a rule saying that net capital gains are going to be limited to the amount of your E&P. So we'll take a look at an example of that in a moment to see what that means. Now, in terms of losses, there is no recognition of current year deficits in E&P. There's no current year offset for prior deficits in E&P. There's no recognition of current year net capital loss. So ultimately, the only time that loss can be recognized is upon disposition. And if you have distributions from and dispositions of a QEF, there's some special rules for how that works. Distributions, those are taken first from your previously taxed E&P, and those would not be a dividend, and then they come out of other E&P as a taxable dividend. There's also something to think about: foreign currency gains and losses from the distribution. And then if you have disposition gains and losses, most likely those are going to be capital if your PFIC stock is a capital asset. Your basis in your QEF is increased by any amount included in income, and that's going to be decreased by any amount distributed that's excludable as previously taxed E&P. And here's a very brief example of QEF in two different scenarios. One is where E&P exceeds net capital gain, and one is where net capital gain is more than E&P. So let's look at the first one under the column PFIC number 1. In that one, let's say you have a PFIC with an earnings and profits of $40,000. There's a net capital gain of $20,000. And so your ordinary earnings are $20,000. You basically just subtract the net capital gain from the earnings and profits. So on your 8621, you'll be showing $20,000 of net capital gain and $20,000 of ordinary earnings. PFIC number 2, in this one you have an E&P of $5,000, but your net capital gain is $30,000. So your net capital gain exceeds the E&P by $25,000. That means you end up with a negative ordinary earnings number. But there's a limitation at play here. The net capital gain is limited to the amount of earnings and profits. So what happens is on 8621, you report the net capital gain of $5,000. So it's your capital gain limited to the amount of E&P. And then your ordinary earnings ends up being 0 because that would not be reported as a negative number. So let's say you're reporting these two PFICs on a Form 8621. In Part 2, you'd be selecting Box A, election to treat the PFIC as a QEF. In Part 3, for the first PFIC, you'd be showing on line 6A, pro rata share of ordinary earnings, that's $20,000. And then line 7A, pro rata share of net capital gain is $20,000. And some of the more complicated things I'm ignoring, or more complicated possibilities I'm ignoring on this particular form, because we're just looking at the very basics. So 6B and 7B are blank, and so you just end up with $20,000 of ordinary income to include on your tax return, and $20,000 of long-term capital gain. For the other fund, it actually ended up having ordinary earnings of 0 and the net capital gain of $5,000. So you just see the $5,000 reported there on line 7A and carried to 7C. Slide 57 here is showing the net capital gain from both PFICs. It's $20,000 from the first one and $5,000 from the second one for a total long-term capital gain of $25,000. And then here's how it would carry to your Form 1040. You would have your capital gain $25,000 and the $20,000 of ordinary earnings from the first PFIC would be shown on line 21, other income. So let's talk about who is eligible to make the QEF election. This can be a direct or indirect shareholder of the QEF, and if you have more than one entity or person in the ownership chain, it's going to be the first U.S. person in the chain who can make the election. So for example, let's say you have a QEF held by a domestic partnership. That means that the domestic partnership is the first U.S. person in the ownership chain, so the election is made at the partnership level and binds all the partners. But if a foreign partnership is the shareholder, then the U.S. partner would have to make the election because the U.S. partner is the first U.S. person in the ownership chain. There's some really specific paperwork requirements for the QEF election. There's something called a PFIC Annual Information Statement, and you actually cannot make this election unless you have this statement, and you're required when you make this election to attach a copy of this statement for each year that you're using that election. The statement has to be signed by an authorized representative of the PFIC, and it has to contain 4 pieces of information, which we'll cover on the next couple slides. It has to contain the start and end dates of the time period to which the statement applies. Any of the following 3 things, either the shareholder's portion of capital gains and ordinary income, or information that allows the shareholder to calculate those, or a statement that the shareholder can inspect the books to calculate the capital gains and ordinary income. The third thing it has to contain is the amount of cash and fair market value of other property distributed or deemed distributed during the period the statement covers, and either a statement that the PFIC will allow the shareholder to inspect its books, or alternative documentation requirements approved by the IRS through a PLR and a closing agreement. Timing concerns for the QEF election, this is going to be really similar to the Mark-to-Market election. In other words, it must be made on a timely filed return. There is an exception to this. It's a little different than the way it works for the Mark-to-Market election. For the QEF election, if you reasonably believed that the company was not a foreign passive passive foreign investment company, you would be able to make a late election. But what that means is you actually understood the laws and you knew what a PFIC is, and you made a good faith effort to apply the law, but something led you to the wrong conclusion, maybe something like a valuation error. Again, for the QEF election, most people are not going to end up doing the late election. The most common reason for making the election, or not making the election, is that you didn't know it was a PFIC or you didn't receive the PFIC annual information statement, and in neither of those cases would you qualify for the late election. So that will end up not applying to the vast majority of cases. So let's take a look at the more common situation, which is making a timely election, and there's two scenarios where this would happen. This is where someone either is a U.S. person and acquires their PFIC in the current year. We're going to use 2016 as our example. Or someone has a PFIC and becomes a U.S. person. In these situations, the QEF rules would work normally the way I just described, and there's no basis step up the way there is for someone transitioning into the U.S. tax system like under the Mark-to-Market rules. If someone is transitioning to QEF from another tax treatment, that's the other way you would be making a timely election. And the way that works is you would need to make a QEF election simultaneous with what's called a purging election. And a purging election can be either a deemed sale election or a deemed dividend election. Let's talk about transitioning to the QEF election using a purging election. Basically, what you need to do in this scenario is make two elections simultaneously. You would need to make both the QEF election and the deemed sale or the deemed dividend election. And there's a reason for this, and that is called the once a PFIC, always a PFIC rule. So what happens is once something is considered under the tax rules to be a PFIC, then unless you do something to terminate that PFIC status is going to remain. So even if it ceases to meet the definition of a PFIC, if it was a PFIC in the past, it's going to retain that PFIC tax treatment. So let's say you're operating under the default rules and you get your first investor statement allowing you to make a QEF election. You would want to make a purging election to terminate the default rules so that you would be able to operate only under the QEF rules. Otherwise, you could be in a really unique tax scenario where you're operating under both the excess distribution rules and the QEF rules. Now, actually, just to go back for a second and talk a little bit more about how that works, the purging election, I don't think I mentioned this, is actually something that you would either need to do a pretend sale or make what's called a deemed dividend election. And under both of those, you would be, basically you'd be triggering a tax event under the default rules. So it's sort of one final default rule tax recognition event before you're moving on and using the QEF rules moving forward. Now, the QEF election under the OVDP and streamline procedure, the very short answer to this is that the QEF election is not available for these. The requirements for making a timely election still apply for the QEF election. So there is no special OVDP rule for QEF like there is for the Mark-to-Market election, and there's no special streamline procedure rule. So unless you had somehow made the QEF election previously on your returns and you're using the streamline procedure, or the OVDP for some other reason, you would not be able to use the QEF election during the years covered by either of those programs. Now, the last section here, I want to talk a little bit about transitioning between the Mark-to-Market election and the QEF election. And this is something that might not be extremely common, but it could come up from time to time. And so I'm going to talk a little bit about the theory behind how this would work, and then in practice what you would actually do if you need to switch from Mark-to-Market to QEF, or probably less common, from QEF to Mark-to-Market. So under the Mark-to-Market rules, the holding period for your Mark-to-Market PFIC is actually going to be reset each year. So your holding period basically begins on the first day of the next taxable year after each Mark-to-Market year. And there's also a rule under the QEF rules that talks about pedigreed QEFs. If you have a PFIC that's been a QEF for its entire holding period, it's called a pedigreed QEF. And if you have a pedigreed QEF, then the excess distributions do not apply. So looking at these rules together, if you're under the Mark-to-Market election and your holding period is beginning on the first day of the next taxable year after each Mark-to-Market year, you could have a pedigreed QEF where no excess distribution rules apply if right after your Mark-to-Market year you were to begin making the QEF election. So in other words, if you just switch from Mark-to-Market rules to using the QEF election, you would have a pedigreed QEF. And that's because you're making the QEF election in the year following the Mark-to-Market year. That's essentially the same as making the QEF election in the first year of your holding period under this Mark-to-Market holding period reset rule. So the conclusion here is that Section 1291 will never actually apply, and there's no deemed sale needed to transition to the QEF election. So when would you want to do this? Let's say you've been operating under the Mark-to-Market election, and then you finally receive your first PFIC annual information statement. I don't know how common this would be, probably not very, but in that situation, all you would need to do is simply start making the QEF election, and you would be able to do that very easily. Another situation is if you had previously made a QEF election, but it was terminated for some reason, and then you become eligible again. In general, you can't make a QEF election within 5 years of terminating the election, but there is an exception that applies where you terminated the QEF by electing Mark-to-Market stock, and then that became non-marketable. So again, that probably won't be extremely common, but it's nice to know it's possible if it's needed. So to do this, on your Form 8621, simply make the QEF election in Part 2, report the income as required under that election, and again, there would be no deemed sale and no purging election needed. Now let's say you want to go the other way. You have a QEF election and you want to transition to Mark-to-Market. If you make the Mark-to-Market election, that will automatically terminate the QEF election according to the regulations, and then you will then be able to switch from the QEF to the Mark-to-Market. That just terminates the QEF election, and there's no deemed sale necessary to do that. The reason for doing this would be if for some reason you were eligible to make the QEF election, but now you're no longer able to, but you happen to meet the requirements for the Mark-to-Market election, you would be able to make this transition. how to do this, simply make the mark-to-market election in Part 2 of Form 8621. Begin reporting your income under Part 4 of Form 8621. Again, making the mark-to-market election automatically terminates the QEF election, so there's nothing you would need to do on the Form 8621 to indicate that other than just make the mark-to-market election. And there's no deemed sale and no purging elections needed. At this point, if there are any questions, we have time for those. Oh yeah, we have questions. Okay, so the first question I have here is, if a fund is registered with the SEC, would this be a PFIC? The answer is it could be. There are other rules at play, but basically, if it's registered with the SEC and it's a foreign mutual fund, this very well could be a PFIC. Now, one thing that you might want to watch out for is PFICs held in certain types of accounts. I believe if they are held in qualified retirement accounts, you would not need to use the PFIC treatment. You would not need to report them on Form 8621. So you might potentially have a PFIC registered with the SEC in a retirement account somewhere that you don't necessarily have to report as a PFIC. It's still a PFIC, it's just you have this exception where you don't have to report it as one. Okay, we also have another question. This one says, the 7% PFIC tax for the first year, and this is referring to the alternative mark-to-market treatment for the offshore voluntary disclosure program. On question 10, it says it is based on 20% tax, so the total tax for the first year is not 27%, but 27% of the gain plus 7% of tax. Right, so the 27% I gave is a compiled figure. So what happens is every year under the mark-to-market OVDP period, you would be calculating your gains and then multiplying your gains by 20% to get your tax result for that year, and then you would just take that tax and add it into other tax on your tax return. For the very first year, basically they're adding in this 7%, and the 7% is actually an additional 7% of gains that is added on, so you end up with 20% tax as your standard amount per year, plus another 7% for that first year. And the reason that they do this is because basically they're assuming that if you're going into the offshore voluntary disclosure program, most people, this is the IRS assumption, have been holding their investment account for a very long time. And so the IRS is getting tax under this program only for the most recent 8 years, but it's missing, in their opinion, they're probably missing several, potentially many years of tax computations. And ordinarily, these people would be operating under the default rules because they would not be able to go back and make the mark-to-market rules. So the IRS is saying to compensate for not getting those interest charges, not getting that tax from the prior years before the PFIC period, they're going to compensate for some of that interest and some of that tax by tacking on another 7% charge. So that's essentially where that's coming from and why it's there. Okay, we have one more question. Do I need to report on Form 8621 if I purchase any foreign mutual fund through a brokerage account, or is it enough just to report it in the FBAR? So if you purchase a foreign mutual fund through a brokerage account, and I'm assuming you mean a U.S. brokerage account, I believe that you would actually need to report it on the 8621, and there are exceptions to this, such as if it's held in a qualified retirement account, but for most normal brokerage accounts, there is actually the Form 8621 reporting that you would need to do. Let's see. Okay, I have a more specific question here talking about specific slides, and I think we have time to cover this one as well. This one's looking at slide 68 and 78. It notes these seem to be contradicting in terms of the purging election use. Can you explain when you need it and when not? So I'm going to take a look back at those slides real quick, just so I know exactly what you're talking about. Okay, transitioning to QEF from another tax treatment on slide 68 and slide 78. Yes, okay. So, right, these do seem to contradict each other. On one slide, I'm saying if you're transitioning into QEF from another tax treatment, you do need to make the purging election with the QEF election. What I'm highlighting here on slide 78 is actually an exception to that. If you happen to be going from the mark-to-market rule to the QEF election, that's the one scenario where you would not need to make the purging election. But pretty much in any other scenario, if you're transitioning into the QEF election, you would need to make that purging election. And then, I actually do have a couple other questions that have popped up. I think we have time. Okay, great. All right, so this one says, if a taxpayer is filing U.S. returns under Streamlined for the first time and has PFICs, can we elect mark-to-market but calculate the first year under 1291? This is an extremely common question. I've seen this one many, many times. The answer is no, unfortunately. The thing is that the election has to be a timely election on a timely return. If you're going back under the streamlined procedure, you're filing returns for years where the due date has already passed. So you would not be able to make a timely mark-to-market election, and this is the scenario where you would actually need to apply for a private letter ruling and have the IRS consent to allowing you to do that. The timing of that, coordinating with the streamlined procedure, maybe it's possible, but unless you have a lot of potential tax savings at stake, it's probably not worth it to go through that process. So there would be a very limited group of people who would even want to go through the process of taking advantage of the late election rules. So the very unfortunate news here is the best thing you can do here is go through the streamlined procedure using the default rules for the first possible year where you can make a timely election, use the transition rule to switch into mark-to-market election if you plan on keeping the PFIC for some time, and then you'll be using mark-to-market from then on. Unfortunately, it's not a great solution, but that's what the rules are. One more? Done? Okay. What if information is not readily available on a PFIC? For example, a client has records of a foreign account with mutual funds, but the information is limited. Really depends on the specifics of that. This is going to be a judgment call. You're going to have to look at what you have and do your best with what you can. Most likely, you're not going to be able to make a mark-to-market election, certainly not going to be able to make a QEF election. So probably you're going to be operating under the default rules, doing your very, very best to fill out the forms as accurately and compute income and tax as accurately as possible. And I believe that's all we have time for.
Thanks, Deborah, and thanks for all of you to logging in and participating. If you have a question, email her. Her email address is on the last slide in the deck. Otherwise, Deborah, Debra.Rudd, RUDD @Hodgen.com. Happy to answer questions and help you out. Next month, the presentation is going to be on August 11, noon Pacific time. Haoshan Zhang is going to be the presenter, and he is going to be talking about claiming the foreign tax credit when you have a hybrid entity. Hybrid entity is a corporation or other type of entity that's taxed as a C corporation in one country and a pass-through in another country. And for God's sake, the last thing you want to do is have a foreign tax credit that's trapped and you can't use it on to offset the U.S. tax return, tax liability. Anyway, that's it. If you want to get announcements of future of monthly tax lunches and the topics, go to our website, hodgin.com/newsletters to do this. Also, it's all on the CalCPA website, calcpa.org. Anyway, that's it. Thanks for participating, and we'll see you next month.
Thank you, Phil and Deborah, and thank you for all of you out there online who attended today. Your certificates of completion will be available for download within 3 business days. Thank you again, and have a good day, everyone. Bye.